Okay, traders, let me just give you my sort of rundown of the non-farm payrolls, what happened, what we need to be concentrating on, and try and work out where if there was any execution issues and that sort of stuff, really how we can basically improve your overall analysis. Now, just on the face of it, you've got to understand that the non-farm payrolls, there's a huge amount of data coming out, right? Now, each of these data releases, right, has their own sort of pulse input into the overall aspect of employment in the US. There are the key numbers, the non-farm payrolls, okay, 235 here. You're really looking at the unemployment rate, right? And probably average earnings, which has come into play in the last, really prominently in the last probably couple of years. Now, these are the main numbers, right? So they all have a different impact. Now, forecast here was for 5.2% unemployment rate, right? So that came out on the money. It's an improvement, but it goes back to the forecast, 5.2. The poll, I think it was 728. So somewhere between 728 and 750 was the poll here. Now that's much weaker. Now, this is a shocker, right? And that should see the dollar fall. But what we're also getting is a bit of an offset here with the average earnings year on year. They are these numbers here, especially average earnings, and probably the unemployment rate to an extent, numbers that you can just look at the prior number and see if the economy is picking up. So with that, you've got a couple of variables here which are better, but especially with the rate, it's not like massively weaker or better. It's just like, okay, it's 5.2. That's what we're expecting. So you're going to see dollar weakness initially, but are we going to get a follow through in the actual number itself? Well, this is where you've got to really piece it together with what the Fed's narrative. They're talking about full or total employment. Okay, if I just bring you across here, I mean this is tricky because they haven't told us what, like, high CPI, usually above 2%, right? They start looking to raise rates or sort of get involved. Now at this point, we've got a situation where we don't even know what maximum employment is. Okay, so there's a couple of things. If you've got Metastock here, have a look at this. Now, this will go to some way to explaining why the dollar didn't just keep running and running and running. It's primarily because it didn't have the extra weakness from other weaker numbers, right? So had the unemployment rate missed the mark, been 5.3, 5.4, average earnings had it been weaker, yeah, by all means, the dollar runs, but we just didn't get everything lining up. So when we are looking at the various aspects, and I was just having a look at this before, there's a number of different things to look at. One is the regional inflation, right? Okay, if you come down to this bottom story here, let me just get off the pen. The regional inflation numbers that came out earlier in the week that paint the rest of the picture were exceptionally strong, right? Now, I mean, this is going to find the answers out to as to why the non-farms didn't sort of go so like run, right? I'm trying to give you that answer. Now, one of the key things is I'm just saying the number on the face of it, we have one number that was a bit of a shocker, right? That gives the dollar weakness. Now, is that weakness coming in with everything else or other contributing weaker factors? Now, the one thing that you've got to look at as well when you look at these numbers is even the participation. Has there been an increase or decrease in the participation rate, right? This is all the different factors that the economic groups in the banks will be looking at. So no change in participation, right? So no drop. That's good. That's an even sort of thing. Now, coming back to look, one of the things I was saying on Friday, if you go back to Friday's Market Insight, now, when you are looking at a situation, and this is why the non-farm payrolls are problematic, if all these things come out strong, all of them come out weak, we get a good 150 to 200 point move, right? We get one variable come out much weaker and the others all pretty much as expected. It doesn't get the follow through push and you get the weakness and then it stalls, right? When the data comes out, this is hard for a lot of traders. Think of yourself as a medium-term trader, right? You're not looking at the general noise here on the numbers. Now, you can get caught up trying to execute, trying to gauge momentum around this. But as I said, if you've only got one number here that's weak, okay, you'll get the move and that'll probably stall. the best thing to do in this situation is have a look at the equity markets. More importantly, the whole number, strong numbers or weak numbers here goes towards the Fed tapering the asset purchases. So look at the asset purchases or the assets. Okay, US bonds, those yields are slightly higher, right? Which tells me, okay, that's a slight, so they're not, for some reason, right? Okay, some variable out there, we don't know what it is, but that really weak number, we saw the yields on the bonds go up, means like slightly higher interest rates. So there's something else going. If anything, it looks like the market was already anticipating massively weak numbers, right? So, and the day or so beforehand, the dollar was already falling. So to me, it's almost like this number here, this bad number, it's like it was almost leaked, was in the market. When you look at the currencies across the charts here, the key move probably already happened the day before, right? And once the number comes out, okay, the rest of the market goes with the weakness in the number, right? And you can see that, as I've been saying, like dollar yen and dollar Swiss aren't really in the game. Dollar yen sort of went with it, but that US dollar move, right? It's almost been factored in. We got it. You get the initial spike and then it stalls again, right? So when you are, so what can you do with this? So, and I know there's a couple of traders getting into kiwi. Kiwi had already come a long way, but you know what? It was breaking a major level. The lack of liquidity around the non-farm payrolls is well known, right? So you do get spikes up and down on the number. Now, if you're using Trendline Trader on any of these numbers, if it's close, right, you can't use Trendline Trader on economic data releases if the data's reasonably close, like even 15, 20 points away, because when the order isn't in the market till it hits the level. So if it's moving very quickly, it hits the level, then Trendline Trader goes to trade, and you'll be trading miles away from the level. Now, Guerrilla Trader, of course you can. It's designed to do that. So, but what your job is to gauge momentum. In a situation like this, where you've got the non-farm payrolls, right, coming out, you should be saying, okay, I've got one variable weak here. Yeah, it's probably worth 2 crosses. It's like really weak. Okay, the rest of the things are online, if not better than the prior, but they're just as forecast. So there's no benefit or no weakness from those things. I would be then coming very quickly, having a look. This is coming back to almost 2007, 2008, 2009, around the global financial crisis, where we were looking at the numbers and then have a look at the impact on the US treasuries and the equity markets. Yields, okay, slightly higher, right? And the equity markets, if those yields are higher, these should have come off. But in actual fact, the equity markets, you'd think that nothing happened, nothing was released. Like they haven't actually sort of moved anywhere, right? This performance here is, you're scratching your head going, hang on, we've got the underlying non-farm payrolls number is weak. Why haven't the equities moved? If they're really weak, the equities should have rallied through the roof, right? But in actual fact, treasury yields went up, equities didn't move. So the currencies, yeah, you got the initial move in the dollar, but then nothing from here. We've got no follow-on effect. And then you need to sort of come back and go, okay, well, that should be enough to get you in and out of the positions. Now, the problem is when this data comes out, it comes out earlier. You got to wait for the equity markets to open up and then see what the impact is to the treasuries as well. So there's a good half-hour delay. So what do you do with that? Well, if we're looking for an overall, so for strong non-farm payrolls numbers, we're going to get, you know, a month, 2, 3 months of strong dollar, right? You don't need to capture the trade, the immediate cash on the trade itself. All right. And saying that, if the numbers were all massively weak, you got a great trade and you're into it. And if you didn't trade, you missed it. So it's a bit of a catch-22, but to be sure of what's going on, you need everything to line up. Nothing was making sense in this front. Now, the other thing is, think of what the market, it's missed the mark here. Why has that missed the mark? Then you come back across, and if you are looking at any variables, and you would have been reading about this prior to the non-farm payrolls, it's all this, you know, the Delta variant and what that's doing for, this may be not necessarily a one-off, but there's a reason why we had this knee-jerk reaction in the non-farm payrolls. It's because the hospitality, leisure and hospitality sector has been hammered due to this Delta variant of the COVID virus, right? So that may be fixed up, it may not be. But I tell you what it does is it makes a very confusing picture for what the Fed, for the Fed's narrative, right? They've been talking about we hit maximum employment. Well, we're going to have to start doing things. Now, it also brings into play US inflation, right? The inflation numbers regionally are at all-time highs in some places. So now it comes back to the overall inflation numbers. I still think there's a chance for the Fed to be pushed into the corner by strong inflation, because I know they've got their narrative saying we need maximum employment, but if inflation's going through the roof, it means everyone's still spending, right? There's still got too much money in the system. So even with the Delta variant and employment not picking up as much as they'd like, they may still have to be, or they may have to do something, right? So, but coming back to trying to trade these numbers, right? It is problematic, more so than the non-farm payrolls than any other number, because you don't get the clean move because there's like 6 variables all up, even though we're concentrating on probably 3. There's really 6. And when you've got a situation where, you know, a lot of the move had been factored into the market prior to the number, to the release, okay, that diffused the initial pop here on some of these pairs. I know sterling pop, kiwi, you know, and the real move, what we need to get is a follow through on some weakness. You're looking at US numbers this week, and that's where the next leg of the move will go, right? We've had a pretty good pullback in the dollar the last week or so. Really, it's come down a long way. Now, the other thing that you need to be thinking of, this doesn't help for execution, is just keep thinking of the bigger picture, right? Because if you've got, let me just come back to the charts here. If you're having a look here now, Euro's back above those resistance levels, but if anything, it's still within sort of recent highs, right? Around that 119, the figure. Funnily enough, it's sort of come back to that level. Sterling's back in the range. Aussie and Kiwi with the 2 pairs, okay, especially impacted by lockdowns, that the market was extremely short, and they have been cleaned up. Now, the Aussie's sort of resting up against resistance up around 74.5, and Kiwi, after the lockdown, pushed the RBNZ out of a raising interest rate situation, has cleaned out all those medium to potentially longer term short Kiwi positions, right? But it's stalling back up around 71.50, and then dollar CAD just drifting down through 125.26 as oil maintains its strong pulse. And the dollar index, I mean, for all money, it's still within recent ranges. I mean, it's going back to July. It hasn't moved far, right? So you've got to be careful getting into trades and trying to manage them. This is the hardest part about the non-farm payrolls. I can just get that data back up. Is when you're looking at these numbers, you're trying to work with the momentum in the market, right? Now let me just actually come back to the Kiwi here, get it on this page. So you've got all these different variables, right? And you're looking to get into a trade, whether it's a break of this trend line. Now, how far has the currency gone on the release? By this stage, you're already looking across the other variables. You know that there's often with the non-farm payrolls, if there's a variance in one of the numbers, you'll get a spike. And then the market, as liquidity comes back in, when they see all the other numbers, it corrects itself back to where it was. So it's problematic. This is a situation where it's just an absolute calamity here on the Kiwi, where it's gone up and down. Now, see the first hour, after the first hour of the data release, you take out a lot of the volatility. The market is reassessing. They're looking at the what's happening on the treasury yields. They're having a look at equities. They're looking at the news that's coming through, the analysis, and looking at all the different variables. The volume of the volatility, I should say, goes out of the market. Then you can start to see how the trend line is now acting as support, right? It starts to make sense after the release. The immediate number, everyone's looking for a quick buck, and it can really give you a nasty kick in the belly if you don't get at least 2 numbers going the way you need it to go, right? So the dollar, in my opinion, like, we got the initial weakness, right? It's, as I said, a lot of these, bit of the move here had already happened prior a day before the release. So I think a lot of the long dollar positions had already been taken out. There's a bit of squaring on this. By all means, this is a bit of a shocker. No, it is a shocker. Like 700, or actually, don't look at the 943s. Think of the 728, I think it was, which was the forecast. Well, that's off the mark. Yep. There's a few other factors which were on the mark. Average earnings slightly better. So that doesn't give you the full run-on effect. And this is one thing to think overall. This is why you need to understand the markets. This number here, right, from everything the Fed's told us, should mean, okay, no tapering from here. It should mean the yields on the bonds should go down, right? Should mean that the equities markets should rally pretty much through the roof. It means there should be no tapering. But what you didn't get the confirmation. So if you're managing positions and you're looking at these other variables here, like bonds and equity markets, for like confirmation of what we know should happen, if it doesn't start to happen, you get out of your positions, right? Like the equity markets did not respond as they should to that weak number, and the bond markets as well. To me, that's like a bit of a market that's confused, and they are a little bit confused because the Fed's narrative is now, it's confusing. They're talking about maximum employment. We don't even know what that is. And when you're looking at maximum employment, you're probably looking at an unemployment rate, right? Not the actual change itself. 5.2%. And you can actually go into these numbers and have a look. You want to start to get a bit of perspective of what is maximum employment. And what you would be looking at is, over the course of, say, 10 years, what is maximum employment? Okay, so, well, it's been down to 3.5 and 20, so maybe it's 4.5, I don't know. But I tell you what, this is making it confusing, is the Fed aren't telling us their number, which is problematic in itself. So what do you do from here? Well, you wait and see. To me, this is a miss, right? This is a miss. And quite often after the non-farm payrolls, okay, you got to look at what's coming up this week. We've got central banks and a whole range of things, but the US dollar to me should still be drifting lower. Okay. Now I would like to see the treasury yield start falling, right? That makes a lot of sense. You get that connection. Don't forget, US Labor Day would have been a lot of squaring up before, basically the end of summer holidays in the US. We're going to wait till Tuesday for the markets to reconnect. So I don't expect a lot of activity. And this is where we may come back as the US market comes back from its long weekend. We may be looking at this and going, you know what, we're going to have an autumn or a fall where the dollar falls because the writing's on the wall. So this is where you come back and start piecing it together and going, okay, well, what do we got? Then you start cruising down through the numbers, have a good look through all the different variables coming out. Okay, we've got the Bank of Canada. I think we've got the ECB as well. Then you've got a whole bunch of UK data, PPI, blah, blah, blah. What I'm sort of looking for is, I think it must be the week after, US CPI numbers. That's probably the next key one. And it's probably a good time for some of the other central banks to chime in. Now, we are waiting for the ECB. They're getting closer. There's a lot of talk end of last week about inflation picking up, and they need to start changing their narrative. That could be the next sort of major move. But when you get a big number that disappoints like the US non-farms because it means so much for what the dollar is going to do next, you just need to take a couple of days. Just let it just flow through, right? If you got caught up in execution issues, now it's really hard to, as I said, just explaining, fine-toothing the price action on the data when each of those 6 variables has their own unique characteristics and profile and impacts the market a different way. It's very hard and problematic, right? We can have a look in hindsight and see what happened here and there, but really the fact is we've got 1 week number. It changes the Fed a little bit. We've got the dollar weakness. It was already in the market. Treasuries and the equity markets haven't moved as they should have for a really weak number. So that sort of changes your profile. So with all of that, you need the clouds created from this event to disappear. As I said, let the water run under the bridge, let the markets recalibrate the data, and let's start to have a look at where things are from here. The major disappointing part is when we've got all these currencies sort of moving around, right? And if I just come back to the charts, we've got, these movements here, like this is all dollar based, right? We want the other currencies like the CAD, the Aussie, sterling, the Kiwi, etc., to chime in. So we have more trading opportunities because it's all dollar based, which is good if we get clean moves. But the situation here is at the moment, it's been a little bit awkward. And now the dollar is sort of in a much, it's at a different level. We're breaking some resistance levels here. Anyway, you need to come back and just take your time, settle back, let the markets tell us what to do. And that's where your knowledge and understanding of, say, risk on, risk off profiles, what the treasury bonds are doing, and the major pairs, how they are connecting to the market, let them tell us what to look for and what to look at. We know to look at the macroeconomic data. Yeah, that gives us something to follow, but we need to see how the market recalibrates after this data. It may have to wait until Tuesday when the US market opens up again before that actually happens. All right. Anyway, a bit of a detailed sort of analysis of the non-farms. I know it's a big, hairy number. Everyone wants to get into it. There's so many like marketing firms that they're going, yeah, get into the non-farms. It's awesome. It's not always awesome. It's hard. It's tricky. We need to just let it go, right? Come back and have a look, see why currencies did what they did. It's just the volatility around the number is quite awkward and hard to work out. But hopefully we can piece it together, see what happens as we go through this week. All right, guys, have a good one. Cheerio.